everybody, so welcome to this video. It is yet another video on valuation basics. So today we will cover the area of cash flows. So when it comes to finance and valuations, cash flows commonly crop up as a vital concept. So let's discuss today cash flows, in particular FCFF, FCFE. So that will be key for today. My name is Irwin. I am a valuation lecturer, and let's see what we can learn today when it comes to cash flows. So we have FCFF. What does this stand for? FCFF stands for free cash flow to firm. And what it basically entails is it gives us the cash flows that can be allocated to a firm's capital providers. Now, we might think, okay, I don't really get this. Now, let's take an example and then we will head back to this concept. When it comes to calculating free cash flow to firm, FCFF, this is the format it takes. First, we have earnings before interest and tax, EBIT. So let's just put some sample numbers. Let's imagine that our company has an EBIT of $50 million. It has earnings before interest and tax of $50 million. Next, we would take in the tax effect. 1 minus T is to tax that amount. So let's imagine our tax is 20%. So I'll put in 1 minus 20%. That means my first row will show $40 million. Now, thereafter, I add back my depreciation. Why? Because depreciation is not a cash flow. So let's add back our depreciation. Let's assume that depreciation is $8 million. I'll add it back. So there I have 48. Next, I adjust for capital expenditure. Capital expenditure reflects your spending on additional assets. You may be buying another factory, another machine. So it will be your spending on additional assets alongside any money you get from disposals of fixed assets. So it is both the buying and the selling that is captured under capex. So let's imagine that our capex for the year, we spent 10 million in buying, but we also sold off some assets. So we got 3 million when selling off the assets. So this is selling and this is our buying. Excuse me. When you net this off, it would be a negative 7 million. That would be the net cash flow on my capital expenditure. And finally, we adjust for working capital. Working capital, it represents how much money we have to set aside to take care of accounts receivable, inventory, and accounts payable. Right? We need to set aside money to work our working capital. Right? No pun intended. Right? So here, let's assume that these three together, they give us a net figure of $1 million. Negative. Now, when we add everything up, so 40 plus 8 plus 7, minus 7, minus 1, we get back the same amount of 40. Now, what is this 40 really? These 40 are the cash flows generated by the firm. Can you see that? First, my earnings before interest and tax. These are the cash flows I earn from my daily operations. Selling to my customers, buying my supplies. So in my day-to-day operations, this is my earnings before interest and tax. I then put in a tax effect because the government would tax me after all. So I factor that in. Thereafter, within my earnings, I add back depreciation because depreciation is not a cash flow. I just want my figures to reflect my cash flows. Since depreciation is not a cash flow, I add it back. Now, next, capital expenditure or capex, it consumes cash. Buying a factory, buying a machine, it takes cash, right? So I will put that in. And I will also put in working capital that consumes cash as well. We have to set aside cash for working capital. And at the end of the day, for the year, I have $40 million. Now, what can I do with this $40 million? Let's go back to the definition. It shows us the cash flow. So this $40 million is the cash flow that I have left over, and I can allocate this cash flow to the firm's capital providers. I can take this money and distribute it to debt holders. Like, hey, this is the interest due to you. Let me pay you for your interest. And if I have certain debt that is due, I have to redeem the debt. I can take some of the money from the 40 million. Yeah, it's time to redeem the debt. So let's redeem it. Let's give our debt holders the money they deserve. Comes from the $40 million. Now, after that, whatever is left, who does it go to? It goes to equity providers. It goes to our shareholders. This is free cash flow to firm. Shows you how much money you have left to distribute to debt holders and equity holders. It is also called unlevered cash flows because it doesn't take into consideration the effects of debt or leverage. When you look here, do you see anything related to debt or leverage? Do you see any interest payments? No. Right? Do you see any debt repayment? No. Right? Do you see any debt raised? No. So in here, we do not consider the effects of debt. It is not factored in. Alright? So this is free cash flow to firm. When we get free cash flow to firm in SCA BG in our module, what is the usage of it? Now, the usage of it is, it helps us to see the cash generating abilities of the firm. Is my firm able to churn out cash? Right? Because it might look like we are profitable, but am I really generating cash? If I'm generating cash, this confirms my profitability, and it also shows that your firm is liquid. Cash generating abilities are more insightful than profits. Alright? Because cash is certain, and that is what we use to give returns to our debt holders and equity holders. Now, second, since free cash flow to firm shows the amount of cash flows that the firm has, to give to all its capital providers, we will discount this figure. When we have to get present value for the 40 million, we will discount it by WACC. Because after all, if you recall, WACC contains the cost of debt and the cost of equity. So since this $40 million is to be distributed to my debt holders and my equity holders, it is only appropriate and matching that for this cash flow, if I want to discount it, I wish to get the present value of it, I would then discount using WACC. And it is common in our exams that we have to discount because you will get free cash flows for year 1, year 2, year 3. So you get these amounts and you would then have to discount so as to get your present value. So when we do it, remember we would discount using WACC. And if I wish to find the value of the whole firm, I just discount all the cash flows by WACC. I get the value of the whole firm. The whole firm being the market value of debt plus the market value of equity. That is the value of the whole firm. Let's see whether I can put this in the same line. Yes, I can. Looks better this way. So, this is what free cash flow will give you. If you wish to find the valuation of equity, no problem. If you know the value of the whole firm, for example, the whole firm's value is 200 million, right? All you have to do is minus off the market value of debt. Maybe your market value of debt is 80 million. And what you'll be left with is the market value of equity, which is $120 million. Okay? Because after all, the value of the whole firm, right? So here I'll put whole firm, is comprised of these two factors. Okay? So this is what we do for free cash flow to firm. Let's continue on. What about free cash flow to equity? FCFE. Yeah? Now, free cash flow to equity shows the cash flows that can be allocated to shareholders only. Earlier, so what is the difference? Earlier, these were the cash flows earlier that were given to debt holders and shareholders. FCFF, that was earlier. Now, FCFE, the name itself already implies it is the cash flow that goes to equity. It is what goes to our shareholders. Alright, so the amount of money that is left that can go to shareholders, it is also known as the dividend capacity. And this makes sense because if this money belongs to shareholders, it goes to shareholders, I could jolly well declare all of it as dividends. This is the total dividends that I could give out. The maximum dividends I could give out if I wish to. So it is also known as our dividend capacity. How much the firm can give out as dividends. Now, it is also labeled several names for the same thing. Levered cash flows because, as you see below, it factors in the effects of debt and leverage. So let's see how we do FCFE. So FCFE is slightly different in its workings. There are some similarities. The similarities you'll see me highlight here. These are similar line items that we saw in FCFF, but the others are different. First, we do not start with EBIT 1 minus T. We start with net income after interest and tax. We start with the income figure that has already factored in interest and tax. Notice, debt will feature heavily here. Because this is called a levered cash flow, we do factor in the effects of debt. So we start off noticing interest is within already. So net income, let's assume a number, some sample numbers. Let's assume $30 million is my net income after interest and tax. And next, I add back my depreciation. So this might be $8 million. Let's just put some random numbers. I adjust my capex. Here, let's assume the net figure is a net $5 million. We adjust for working capital. We can just use $1 million again, like before. Now, here, adjust for debt issuance. We may be able to raise debt from the public. We may have done so. In that case, isn't the money taken from debt, isn't that a cash flow? It is. It is a cash flow. So, let's add it in. Let's say we raised $10 million debt. Okay? And at the same time, we may have had a loan that is due and we paid off 3 million for a separate loan. Debt principal repayments, I paid off 3 million for a separate loan. This, when we add it up, is our FCFE. So 30 plus 8 minus 5 minus 1 plus 10 minus 3. We will get $39 million. Now this is my FCFE, and this is the amount of money that I could allocate to shareholders. I could even give out a maximum of $39 million in dividends. So what is the usage of FCFE? Now, the usage of FCFE in our module is to assess the value accruing to shareholders only. Alright? This is useful if I wish to see, as an investor or a shareholder, how much money comes to me. It also gives us additional insights for heavily leveraged firms. It shows the impact that debt has on cash flows allocated to shareholders. Right? So I would like to see, based on the debt this company is taking, how does it affect my final cash flows as a shareholder? FCFE will give you a good look at this. Now, because FCFE, this amount of money goes to equity holders, shareholders, doesn't it make sense that we would discount this figure by the cost of equity when we are valuing the firm? Here, when we are valuing the whole firm, maybe let me specify a little more and clarify. This might be confusing with the above. I would like to cancel this out if you don't mind. Let me simplify this. You discount by the cost of equity to find the valuation of the equity of firm. Okay? So when we are valuing the whole equity, which is what we buy when we acquire a firm, right? When we acquire a firm, you essentially take over all the equity. So what is the total value of the equity of the firm? You could use free cash flow to equity, discount it by the cost of equity, and you get the value of the equity of the firm. And same thing, people. You will have FCFE for multiple years, year 1, year 2, year 3, year 4. Yeah? You would discount it and you would get your present value, and that's how we do our valuation. Similar to FCFF, right? And as I said earlier, in our exams, we often get an M&A question. So keep in mind, in an M&A, like I mentioned, the acquirer will value the equity because that is what it wishes to buy out. So to buy this equity, what is the valuation? And that is FCFE. So keep in mind the differences between the two, FCFF, FCFE. To recap, what are the main differences? Number 1, FCFF, let me highlight above, is the cash flow that goes to your debt and equity providers. So you do all your calculations and you'll be left with a big pool of money, a big amount of money. This money is to be distributed to debt and equity holders. Yeah? Whereas FCFE, you would in your cash flows already pay off debt, already show the effects of debt. So while you're doing your calculations, debt is factored in. If you have already cared for debt, the final amount left, the pool of money left behind at the end of the day, this is the amount of money that is given to shareholders only. Right? It's allocated to shareholders only. That is the key difference. So folks, I hope you learned much here. Thank you for joining me. Again, if you wish to connect, like in all my videos, connect with me on LinkedIn. Drop me a message there, I do reply. Or you could drop me also a personal email. This is my email address, irwinluo@learningluminarium.com. Meanwhile, it was a joy again to have this small session. Thank you, and reach out with any questions, okay? Thank you. Bye-bye.